And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA Corporate and Investment Banking, turning intent into execution. That's how ABSA are invested in Africa's energy future. 9 minutes after 6. Good evening. Welcome to the program. I'm Stephen Grootes. I was astonished, angry, actually, I should say, at the decision by the International Trade Administration Commission. How dare they impose an extra tariff on peanut butter? I mean, my earliest memories of school are completely intertwined with peanut butter sandwiches. I'm sure I'm not the only one. And then there's the family argument about whether you want crunchy peanut butter or smooth peanut butter. And if you haven't had one of those family arguments, well, it's coming your way at some point. Once the children have an opinion, I guarantee you it's coming. I'll be very interested, please, in your first memories of peanut butter. Is it something you love? Is it something you hate now? If you were given the texture of the bread that you had in your lunchbox with peanut butter, would it take you back to, I don't know, that first day in grade 1 or sub A or goodness knows what it was called? Or would it take you back somewhere else, maybe even before you went to school? If you were young and didn't have much money, maybe don't have much money now, you might still actually eat quite a lot of peanut butter because there's so much protein in it. I do understand why the Trade Commission has done this, and we'll ask Ayabanga Kawe, how dare he, a little later. But still, it is to protect our producers. But your memories of peanut butter, the role it's played in your life, I think for millions of people around the country, peanut butter is a tremendously important thing. Some of the advertising sort of rings in my brain from time to time. Before we get to Ayabanga Kawe, that'll be just before 7 o'clock. We'll speak to Mpumi Zikalala, the CEO at Kumba Iron Ore. Their profits nowhere near as high as last year, but sort of some technical reasons for that and high operating costs too. Miyelani Holeni has been looking at this decision by the National Treasury to actually release the money that was withheld, the municipal funding. It's over 7 billion rand. I mean, my own sense, I'm afraid to say, I can understand why the finance minister's done it. There was huge pressure on him. There were consequences if you don't pay it over. But what else can you do now to get councils to manage their money? I mean, what do you have left? No carrots going to work, so what do you do now? I mean, that I find really quite frustrating. That for me is the frustrating part of it. And then we'll also talk to the Independent Film Producers Organisation. We tried to get the Department of Trade, Industry and Competition to come and respond to why they haven't made payments from the Film Incentive Commission, the Film Incentive. They just haven't. They just won't. And I mean, last time I checked, we did believe in accountability. I must say I'm quite frustrated by this. So we'll investigate that a little bit further. I find the fact that they won't answer questions in the media about it really quite disturbing. I'm afraid to say I expected better from the department. If you have a better explanation of why they just won't make the payments, I'd really appreciate it. 011 883 0702 021 446 0567. And please, your memories, your thoughts, your loves, your hates, and why crunchy peanut butter so obviously better than smooth peanut butter on 072 702 1702.
The Money Show
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
Kumba Iron Ore reporting today its profits down 41% for the 6 months to the end of June. Freight prices jumped by 47%. These results also affected, I must just point out, by the comparison with the results from last year, which featured a big once-off payout from Transnet. Other factors, though, stronger rand to the dollar, several other external factors pushing up their costs. And Mpumi Zikalala is the CEO at Kumba Iron Ore. Mpumi, good evening, and thanks so much for the time. Quite a few factors pushing against you. You obviously want to try and reduce costs as much as you can. Are you able to do much more to reduce your costs and boost profits, considering what you've already done?
Hi, Stephen. Great to be joining you again. Just a small comment, by the way. I do prefer crunchy peanut butter, but let's get back to the business. Now, if I do look at our business, I spoke about the fact that when one looks at our operating expenses, they actually increased by 4%, which is more or less in line with inflation. And that's because our teams fundamentally focused on improving the space that we control, both from an operational efficiency perspective as well as a cost efficiency perspective. And interestingly, to your question, we believe that there is more that we can continue doing. And as a result, we spoke a little bit about our Full Potential program, which fundamentally talks about additional things that we will continue looking at as a business. And it ranges, Stephen, looking at our own operational efficiencies, covering both the mining and the processing side of the business, looking at how we buy, where we believe that we can actually leverage the scale of our business and actually get better prices from our suppliers, and also just looking at how we spend as a business. So the journey will not end for us. We'll continue seeking to improve the things that we can control as a business.
We tend to think of the Northern Cape as dry all the time, but you actually had record-breaking rain. I think it was April and May, the worst rain there since the 1960s. That must have had quite a big impact on your production.
Stephen, let's talk about the rain first. In terms of Kolomela, it was the highest recorded since 1918. And in terms of Sishen Mine, it was the highest recorded since 1963. And that's simply because the two operations are around about 100 kilometers apart from each other. So it was massive. And if you think about it, we typically get rain in the Northern Cape, from around about January to March. And we do sometimes get limited amounts of rain in the second quarter. But this was beyond massive. And it just continued, and it was significant from a flooding perspective. What I'm proud of is that, first and foremost, our teams focused on first things first, which was ensuring that each and every person that works for us was kept safe. And they also assisted our communities because, as you can imagine, our communities were also impacted. And then secondly, from a flooding perspective, we increased our dewatering capacity and also just our drainage infrastructure and pumped the water out, particularly from the pit areas, in order to get back to stability at an operational level. So if one looks at our results, I spoke about the fact that our waste mine increased by 4%. I actually wanted it to increase more than that, and the bulk of the difference was due to the rains. And then from a saleable production perspective, that was marginally below what we delivered last year. And I, again, would have wanted that to be a little bit higher. And going into the second half, with all the additional work that we've been doing, simply because during this period, we couldn't run, so we focused on maintaining our equipment. I do see that putting us in a good space as we head off to the second half of this year.
You're also trying to use a lot more renewable power, and in fact, your latest solar deal reduces some of your emissions by around 35%, or one category of them. Does that reduce your costs? Are you finding it much cheaper to use or to buy that renewable power than buying it from Eskom?
Yeah, Stephen. So two things have taken place. Since March, we actually started feeding our Kolomela mine from renewable energy from Envusa. And that's linked to the Corozon 2 projects that Envusa actually launched around about the beginning or the end of the first quarter of this year. And clearly this energy is cheaper. And then, as you said last week, we announced that we had entered into a deal with Envusa for the development of the Sishen Solar PV, which is about 63 megawatts. And again, we are expecting to actually be able to purchase that at a reduced cost relative to Eskom. Fundamentally for us, though, it will also assist us with our own decarbonization. So we always talk about the fact that when our customers buy our iron ore, they are able to drive their decarbonization agendas. And as a business as well, we are a responsible business. So fundamentally, the move towards renewable energy will assist us with our own objectives when it comes to the decarbonization of our business.
Talking about your customers, I mean, you seem very confident about demand over the longer term for iron and steel, and you make the point there's limited availability of scrap, and urbanization, which is a global trend, drives demand. And I completely accept all of that. But China's property boom is obviously over, and I mean, that's affected Chinese steel production. Is that having a big impact on the prices you get?
So if you just look at this year, and then I'll come to the long term. Interestingly, for the first 5 months of the year, we saw strong demand for iron ore with robust consumption. Clearly, there were reduced levels of consumption from China as the various mills started experiencing pressure with regards to their margins. I guess if you just, however, look at the first 5 months, Prices were also supported by the higher freight charges that you referred to a little bit earlier. And then we saw some of the steel exports going out of China into other regions. Clearly, prices were under pressure from June, and that was linked to the margins from the steel mills actually reducing, and also the pressures from the Chinese property sector. And what we saw was that we, however, saw a slight improvement in terms of the infrastructure sector in China. Even with all those prices or all those pressures, when we do look at the long-term outlook, we fundamentally look at a couple of things. One, we talk about the fundamental factors that will drive demand for steel in the future. One, it's decarbonization, and as the world decarbonizes, the world will require steel, because you have to put all these fundamental infrastructures that are linked to decarbonization on a foundation of steel. The second thing that we speak about is the fact that global population will grow. And as we know, when the population grows, you actually need more infrastructure, and steel, again, is critical to this. Now, coming back to Kumba, we fundamentally focus on the production of high-quality iron ore. And as the world decarbonizes, what we do know is that when our customers utilize better quality iron ore, they get to realize a 2.5% improvement in their carbon emissions. And when they utilize lump, which is one of our products, they get to realize a further 10% reduction in their carbon emissions. And we are starting to see this shaping up. If one looks at just Europe, we've seen Europe implementing what's called the carbon border adjustment mechanism, where they are actually applying a levy to iron ore that's produced with an element of huge carbon or higher carbon emissions. And that's not something that's associated with our ore. And we do see ourselves actually benefiting from this. And that's just from a global outlook perspective. As pressure increases in China, we do continue to see increased demand from the likes of India as well as Southeastern Asia as well.
Mpumi Zikalala, I really appreciate the time. Thank you. Not only is she the CEO of Kumba Iron Ore, but also has exquisite taste in peanut butter. It's 21 minutes after 6.
7:02. Stephen is on the Money Show.
6 to 8 p.m.
The Finance Minister Enoch Godongwana and the Cooperative Governance Minister Nkosini Hlabisa announcing today that the National Treasury will now pay out the balance of the equitable share that government had withheld from 49 municipalities. Godongwana had said the councils were not spending their money properly. Many of them had unfunded budgets. Earlier on 702 Drive with John Perlman, the Director General for Intergovernmental Relations at the National Treasury, Galala Sengharekwe, explained the latest decision.
So as you rightly said, we withheld the money for 69 municipalities. And I think since that time, every week on a Thursday, we've been releasing some money. So to date, we have released, for example, for 20 municipalities of the 69 have received full allocation due to them because they have met the conditions. And some of them are just to, for example, promise that they will in future commit, not just promise, commit that the future administrations that they'll always table a funded budget. Some of them was to have a payment agreement with pension funds that they owed money of the workers.
Right.
Yes, and others, ESCOM and water board and so on. So they were to have a payment agreement coming with it, and then once you come with a payment agreement, we'll give you a portion to go pay what you have agreed with this particular creditor.
Galala Sengharekwe explaining the decision earlier from the National Treasury. Miyelani Holeni is a municipal governance expert. Miyelani, good evening. So, the Finance Minister had been very clear in his communication on this. This was because the councils weren't managing their money. Now he says he'll pay it over. Has he just given in?
Well, I think the task that he had to overcome now is to balance the service delivery imperatives versus the compliance. So obviously, his role is to ensure that the letter of the MFMA is followed absolutely, but he also realizes that if this goes on for a prolonged period, it may start to affect municipalities adversely. It is month's end currently. Some of the municipalities rely on those funds to meet their full obligations. But in terms of, how they've gone about the process of at least seeking commitment seems to be the right way.
So I accept that he possibly had no choice. He was going to be boxed in a corner. There were all sorts of really bad consequences if these councils didn't get the money. But hasn't he also given up the only instrument he could use against councils? If they're going to get their money anyway, what can the National Treasury do to make them manage their money better in the future?
Well, the reality is, Stephen, and I think the understanding and for everyone, equitable share is an unconditional grant. So the moment you start holding an unconditional grant using other conditions, you start to also violate the MFMA in terms of how the disbursements go. So in this case, there must be a balancing act. So the period that you can withhold that equitable share should not exceed at least 30 days until the corrective measures are done. So it is not really an instrument that a minister can rely on or Treasury can rely on. Instead, what they need to be looking at is how they apply Section 154 of the Constitution to support municipalities to be able to comply even before they get to a stage where the equitable share must be released. And we all know that there is a timetable, or it's at least planned when the equitable share is released. So between now and then, we need to look at how the provinces also come in through the treasuries as well as the COGTA to support municipalities to clear those issues. Then it does not become necessary to use such a stringent measure of withholding the equitable share because it is an unconditional grant or it falls in that category.
So would it have been illegal for the National Treasury to hold it past the end of the month, which is Friday?
Absolutely, because in as much as they are trying to correct a particular area, which is the governance and management of finances, you cannot withhold. I mean, you can go into the Division of Revenue Act. The equitable share in its category and the way that it's classified, it's not a conditional grant. You also have conditional grants which municipalities must meet particular conditions to be able to have the grant, released. So that as an instrument for at least making municipalities to comply may not be an effective one going forward. However, we've seen that it could be that they have found a way of at least putting circulars to be able to enforce this measure. But we don't believe that will be the right way. The right way is to be proactive, and the right way is to offer the right kind of support and to cite the kind of municipalities that are there. If there is reasonable doubt that, or at least evidence that there is criminal charges against some of the people, then the AG also has those powers to be able to support the National Treasury in their audits to fast track the prosecution of some of those people that must be prosecuted. Otherwise, disciplinary actions can be recommended, especially because you have an accounting officer that is in place. But even then, the measure to leave things towards the end, we believe that, could at least be improved so that there is proactiveness.
Miyelani Holeni, thanks so much. Really appreciated. Municipal Governance Expert on The Money Show. 27 minutes after 6.
The Money Show.
The markets.
Kwena Maloko is with Equity Research Sales at ABSA CIB. Kwena, good evening. Kumba Iron Ore, the CEO likes crunchy peanut butter. I don't know if you do too. Obviously, the numbers are overall disappointing. A lot of factors outside their control.
That's right. And I'm a smooth peanut butter person.
Oh, first one on the show.
No, but I think for Kumba, if you just look at the results, especially the silver lining, which is that full-year guidance was held, and you look at that compared to what we've seen in the stock price over the year, it's down over 27%. So when they were able to tell us that they're holding guidance for the full year, it sort of implied to the market that some of the headwinds that they're seeing on rand, on input costs, those will partially reverse in H2, and therefore there's a better sort of equity story to look forward to.
Boxer results, their turnover obviously growing quite strongly, not as strongly as it has in the past, and then also being hit by lower food prices. Good for us, not so good for them.
Exactly. And I think that's why you saw the share come off 1 and a bit %, right? But they did flag, and they've been flagging it over time, that deflation, especially in the staple categories, so like you said, maize, flour, rice, is actually accelerating. So currently what you have is negative 2% internal inflation. All that means is that your volume lever has to now more than make up for your in top line, so that you still grow at the same rate. But I think also another thing that investors were looking at was what this means for the broader sector, right? It's unlikely that Boxer is experiencing this deflation by itself, and then potentially we have to start questioning our own sort of profit estimates. The silver lining and the comfort for me was, at least at a profit level, they're saying they're growing at the same rate. So they're really pushing the volume lever.
It also shows you how hard it's going to be for Pick and Pay to recover in a deflationary environment.
Exactly. Them and SPAR are the two question marks that the investment community has to deal with, and the deflation story doesn't help at all.
Fitch has put out a sort of one of their semi-annual, I think it's every 6 months, sort of global reports, and they're very worried about the AI boom and the risk of a correction. They suggest that's actually a major global credit risk. Are you joining the worry?
I think it's a very fair assessment. If you look at what they're saying, is that it's not just a tech theme anymore. It's not just an equity story anymore. In fact, there's so much AI investment that the total IT investment in the US contributed 1.4 percentage points to US GDP. So increasingly the market is pricing in some very bullish expectations. And the risk here is that if the AI story doesn't translate in terms of returns that the market expects on time and on budget, hopefully, and you have this AI spend reversing, it's not just that the equity market derates, right? Because most of your returns for the last 3 or 4 years has probably been from, we call them the FANG, Mag7, all of these AI winners. But what these tech companies have done to fund this AI spend is also issue about $200 billion worth of investment grade bonds. So you have two asset classes at risk if the AI trend, investment trend reverses, but you also have the growth impact. And we know that once there's global risk off, very limited impact on South Africa directly, but if you have a growth impact in the US and the S&P catches a cold, we are going to catch a fairly vicious bout as well. And not only just South Africa, it's an emerging market issue as well. If you have the global risk appetite deteriorating, there's no way emerging market equities, currencies, and capital flows can outperform. So it's quite scary. But we're very early in terms of AI returns, right? Everywhere you look, everyone has their opinion, and we're yet to see it translate into earnings for now.
Sure. Thank you very much indeed. Kwena Maloko from Equity Research Sales at Absa CIB, just after 6:30.
WhatsApp Stephen
on 072
702
1702.
21 minutes to 7. Well, in a moment, we'll have the Chief Commissioner at the International Trade Administration Commission, Ayabonga Qawe. We'll hold him to account for his decision to, how dare he, impose tariffs on peanut butter. In the meantime, your first memories? Are you a crunchy, a smooth person? I'm crunchy. Mpumi Zikalala is crunchy. Kwena Maloko, is smooth. What do you think?
How's it, Stephen? Yeah, the peanut butter price going up is not great. I've been watching it over the past 3 months. It's kind of like my price index when I go shopping, and I relate everything in the store to the price of peanut butter because it just keeps going up. So I shudder to think what's going to be happening in the next couple of weeks or months to the price of peanut butter. In our household, we live with peanut butter. Everything is peanut butter, right? And as shocking as that might be, it's not nearly as bad as what the guys have done to the taste in Prenutra. I still think that's completely disastrous. But the peanut butter thing isn't great either. Thanks for a good show. Neil here.
Thanks, Neil. I've had complaints in my house about Prenutro too. They changed the formula. And it's been going for years and years and years. I can't understand why. Other views on peanut butter tonight?
Hi, Stephen. I love peanut butter. But I think there is a very clever little trick that most people just don't know about peanut butter. It is the most miraculous cure for hiccups. So if anyone has hiccups, you just give them a tablespoon of peanut butter and it is guaranteed to take them away. So that's one very good reason for having keep peanut butter in the house always, and preferably smooth. Have a great evening.
I did not know that. Hiccups. Okay, who knew? Things you learn on The Money Show. 19 minutes to 7.
702 with Stephen Grootes.
Email him on stephen@702.co.za.
14 minutes to 7 the time. Well, last night on The Money Show, you heard me promise we would contact the Department of Trade, Industry and Competition about the problems with their film incentive program. It appears they haven't made a payout for 5 years. It's also understood the committee that determines which projects will get funded has not actually met for 2.5 years. I've got to tell you, I'm not sure what the officials are doing with their time. There's someone in charge of that project. I mean, I don't know what they're doing. We did ask the DTIC to come and respond to that. Jack Devnarine was on the show last night. We were told they're unavailable for interviews and would release a statement. Now, I haven't been able to see the statement yet. It is possible I missed it, but I certainly haven't seen it. We have looked for it. If we get it, if someone brings it to my attention, I'll obviously bring that to you. Luc Roos is an executive committee member of the Independent Film Producers Organization, joins us now. Luc, good evening and thanks for your time. I know we're not the only people trying to get the DTIC to explain themselves. This must just be incredibly frustrating for you.
Yes, good evening, Stephen, and to your listeners. It feels like I've spent my professional career trying to get the DTIC to explain their actions. We have been meeting with them as a result of the action that took place at the beginning of last year as well as at the beginning of this year, where we picketed and marched outside the DTIC offices and in Parliament in Cape Town, and that resulted in a portfolio committee meeting on the 17th of February, in which the DTIC, Parks Tau, and his DDGs and the like were summarily given a bit of a smack over the wrist and said that this is crazy, what's going on, why have you not been paying out these incentive claims or receiving any new claims for the last 2.5 years. And so we've been meeting and trying to get to the bottom of it. And it's just been an incredibly frustrating process, almost 6 months into it now. And we've had no love and no joy. And we've lost faith in the leadership of the film unit to continue the negotiations. And so we're asking Parliament and the DTIC minister to remove the leader of that film unit so that we can negotiate with somebody who we have more faith in.
Do you know what the hold-up could be? Is there a dispute with the National Treasury over the money or something like that? I mean, I realize government has competing objectives and responsibilities and obligations. Has there been some kind of decision that no one will say to change where the money's going, or are two government departments arguing over it?
Well, the marches and a number of PIA applications later, we have gotten to the bottom of what actually took place. And in 2023, the DTIC leadership had racked up a contingent liability just over 2 billion rand, which is doesn't sound like a lot for government, but our sector really relies on those funds. And so they effectively stopped the incentive for 2.5 years and used the money allocated to it to pay down that debt. It's now reduced to roughly 233 million, and they have received their next year's allocation of their budget. They received the budget in 3-year increments, and so we know there is money in the account. That budget has been passed by the portfolio committee, and we were just really confused. Why are you not spending it? Why can we not restart the adjudication committee? And why can't we go out to the industry and give the good news that, hey, the incentive is back on, let's start restarting things? I mean, our industry is really suffering. We're at a confluence of a lot of problems. The NFVF, National Film and Video Foundation, has got a leadership crisis on its hands. It's got its 7th CEO in 3 years, has just been appointed. Broadcasting is suffering massively. We don't have to talk about the SABC. I think everyone knows the issues there. And, this incentive is meant to be a catalyst for international co-production, for local production. It's a producer's piece of the pie that we can bring to the table to try and get and attract foreign direct investment, job creation, youth employment, et cetera, et cetera. The film industry is uniquely positioned to be able to solve a lot of those problems. Most people on a film set are female. Most people on a film set are young, under the age of 35. And just a horrible loss of opportunity, and nobody seems to be taking it seriously. It feels like every time we have to march to get anyone to pay attention to us.
The contingent liability, I realize you had to jump through all sorts of hoops to get to the bottom of this. Was that money that was racked up by the by the film incentive, or was it just other money and they were using, it was debt from something else and they were using essentially the film money to pay it?
I can't give you exact answers there because I don't have them. What I do know is that in 2023 it was 2 billion. I do also know that in 2020, 21 and 22 there were environments. That's another accounting term I had to learn, that the film unit took money out of our budget and moved it across to other line items and to other incentives. And that we suffered. And it was about 330 million rand was moved over the period of 3 years. And so they took that money out, and then we just, didn't get it back. And then they stopped the incentive for 2.5 years. So it really feels like we've had the short end of the stick. And I just hope that, the minister takes our concerns seriously and addresses them.
Luke Roos, thanks very much indeed. Executive Committee member at the Independent Film Producers Organisation. In a moment, the Chief Commissioner at ITAC, Ayabonga Chawe. Why is he putting up the price of peanut butter? How dare he? He'll explain in just a moment. 8 minutes to 7.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking, turning intent into execution. That's how Absa are invested in Africa's energy future.
6 minutes to 7. All right. Well, I was horrified to hear that the International Trade Administration had dared to increase the tariff on peanut butter. And I was lucky enough to have peanut butter in almost all of my sandwiches when I was at school. Plenty of people in my household eat it today. It's good, cheap food. ITAC's increasing the customs duty on peanut butter from 91 cents a kilogram to 20% of the volume price, or what's called a 25% ad valorem. Ayabonga Chawe is the Chief Commissioner at ITAC. Chief Commissioner, good evening. What have you got against peanut butter? Why have you decided to increase the tariff?
Good evening, Stephen, and I heard your question saying, how dare he? Well, I must tell you, I'm yet to break the news to my mother, who is a big fan of peanut butter. So
yes.
You'll have to bear with me. But really, I think, Stephen, it's two related reasons. I think the one is, as you said in your introduction, you would have had a specific duty rather than an ad valorem duty on peanut butter. So peanut butter was tariffed at 99 cents per kilogram prior to this decision. But the anomaly you had was that groundnuts, which are used to make the peanut butter, were fetching a much higher duty, ostensibly to protect groundnut producers in the country. And you also would have had considerable price disadvantage if we compare our producers to some of the producers in other parts of the world who have much better scale and, of course, are able to produce product landing at much cheaper prices in South Africa. So on the balance of the evidence before us, we took the decision to not grant the 25% that RCL as the applicant would have wanted, but to provide a 20% duty in this case. On the back of the case that was made before us. And we do understand many people are very favorably disposed to peanut butter, including my mother, and that we certainly do hope, from what we've seen in the post-COVID period, where you've seen a massive price surge, both of the imported and the domestically made product, that this is not going to lead to some pricing alarm on the part of many retailers.
Well, I mean, this is the other thing. For some people, it's an almost staple food because it's quite cheap protein. And I realize, I completely understand the need to support local producers. But, that must be a big factor that weighs on all of this because it is. I just think of the school feeding schemes. I'm sure there's a lot of peanut butter there.
Mm-hmm. Yes. Well, certainly, Stephen, and that's why in this investigation, one of the things that we had to do in order to make a case, not just to the Commission, but to the two ministers, the Minister of Trade and the Minister of Finance, is to undertake a consumer welfare analysis that looked at the incidence insofar as household income is concerned of where peanut butter is consumed. You make the point that it's one of the cheapest protein sources. Well, the reality is that certainly since 2020, prior to the onset of this particular tariff, you've seen the per kilogram price of peanut butter coming in much higher than the per kilogram price of other comparable proteins. So you already have a product here, which, as I was saying, both on the import and the domestically produced product, that has seen a surge in pricing. And really, I think the task that you allow those who have made investments to be able at least to protect the capability they would have invested in. But second to that, Stephen, it's important for the reasons you outline, including the National Nutrition Program, that you have an ecosystem of groundnut and peanut butter production that is resilient enough. Because you can only imagine once you become totally import reliant or have a near total reliance on imports, that any of the vagaries in key producer markets like India would take you out kilter. And I think we've seen, certainly in the case of India, which is one of the origin nations here for peanut butter, the use of export bans on things like rice, export bans on certain product categories, which I think does make the case for domestic production much stronger. And in this case, as I said, you had to deal with a tariff anomaly where the input product was coming in at a higher duty than the finished good, and also to recognize that capacity utilization levels of some of the new investment that have been put into play needed to be improved somewhat. And a big part of doing that was to equalize the price disadvantage experienced by domestic production.
So hopefully it will strengthen local producers. Are you going to be reviewing this tariff from time to time? I mean, you'll need to see that actually local producers are suddenly able to produce more and that the pricing kind of is acceptable and manageable.
Well, indeed. I mean, I think one of the things we've said in the report to the minister is that we would like to review this decision 3 years subsequent to it. But second to that, we're not only reviewing the decision, we're reviewing the pricing behavior. We don't want a situation, Stephen, where you find producers are pricing into the tariff, or even retailers are pricing into the tariff. And we'd like a situation where, were we to find that there is this kind of pricing power being priced into the tariff, that alongside the competition authorities, we will respond. So we do wish to extend some caution to some of the producers here, including the applicant, and some of the retailers who retail the product, that were we to see a considerable upward increase in prices that is not commensurate with the underlying production cost structure, we certainly will interact with the competition authorities and act accordingly.
Ayabonga Kawe, I wish you luck with your next trip, I presume to the Eastern Cape to break the news. I'll come with if you need help. The Chief Commissioner.
Thank you so much. Thank you so much, Stephen. Take care. Cheers.
Ayabonga Kawe is the Chief Commissioner at the International Trade Administration Commission, preparing himself for a difficult conversation with The Money Show at 7 o'clock.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking, turning intent into execution. That's how Absa are invested in Africa's energy future. 7 minutes after 7. Well, I was just talking to Warren Ingram. He's sitting behind me. He'll be with you in personal finance. We'll be talking about buying property to let it out, what you should know, the pitfalls and all of that. He tells me, and it's the only reason I'm actually allowing him in the studio, that he is a crunchy peanut butter fan, I'm pleased to report. We will talk more about that when he comes in a little while. Don't forget Professor Rutindo Ndingwi as well. He'll be updating us on what's happening across the continent. And in a moment, we'll speak to Anusha Naidu, the CEO of the Southern African Venture Capital and Private Equity Association. They've been doing a lot of research on basically whether it works, and some of the outcomes are really interesting, and they're talking about our venture capital market putting money into companies becoming a lot more mature and just getting to a better place. I think that's going to be an important conversation. Good to hear from you tonight as well on 011 883 0702 021 446 0567, and of course voice notes this evening on 072 702 1702. Plenty of conversation tonight about the great peanut butter debate.
Good evening, Stephen. I just heard Tola Gele saying she's not the one for peanut butter. Like, what? I think she should be taken to some inquiry or something. The way I love peanut butter, and as you rightfully said, nowadays it's so expensive. As long as it's written peanut butter, I'm buying it. Because, peanut butter is so expensive. You can call me a cheapskate all day. I don't care. I'm just, as long as it says peanut butter, I know the quality or the taste is probably compromised, but oil in my books is still peanut butter. And yeah, I don't know if people know of the trick of warming peanut butter before you put it on the bread so that you don't use too much of it, or so that it's not too thick to apply on the bread. Thanks.
He warms the peanut butter. I'd never tried that. Kids, when I get home, trying something new. Other voice notes tonight.
Hi, Stephen. I did not expect 702 to incense its listeners to this degree. Of course, crunchy peanut butter is the best. We don't even need to listen to the people who like smooth peanut butter. Okay, now, my first memory of peanut butter is from school. My dad making peanut butter and syrup sandwiches, and the syrup side would always have been completely, drowned in the syrup and kind of this sticky, crystallized thing by the time that it's break time, while the peanut butter side held up. So I think actually it is better to mix the peanut butter on both sides, to get them on both sides, and even to mix it with, back then we had margarine, now I'm a butter snob. Okay, cheers. Elizabeth in Pretoria.
Oh, sensible person, Elizabeth. Thank you. I hadn't thought of that, actually. Peanut butter and syrup. I have had that, but I can't tell you. I mean, probably years and years and years. A millennium ago. But now there's something I also hadn't thought of. Peanut butter and syrup. Maybe, if the younger members of the Grootes household behave tonight, just maybe tomorrow, 10 minutes after 7.
The Money Show with Stephen Grootes
On 702.
702.
It is with great sadness that I'll drag myself away from the great peanut butter debate, because we need to talk about venture capital on the Money Show. And the SA Venture Capital and Private Equity Association, the SME Fund, and Endeavour South Africa say their new survey shows that venture capital funds sold companies they had invested in. When they did that, they were able to get out more than twice the money they put in. In other words, I presume, it looks like they doubled their investment. In other words, they put money into the company, they got more than twice that out. Anusha Naidu is the CEO of the Southern African Venture Capital and Private Equity Association. Anusha, good evening. You looked at 226 cases where venture capital funds had put money into companies and then sold those companies. They exited, in the jargon. What did you find?
Hi, Stephen. Good evening to you and the listeners, and thank you for having us. The exit study was quite phenomenal. Being able to track the last 17 years of exits in the South African ecosystem and showing the value accretion of exits in the VC ecosystem, returning more than 2 times capital invested, which is quite a stellar statistic and very much in line with international statistics that we see in the space.
How did you decide on which transactions? I mean, there must have been cases where funds put money into companies and made a loss.
Yeah, for sure. That's the nature of venture capital. Not all of the invested companies will realize a successful exit, but these were very specific case studies that we had done over the life cycle, where we had investor reporting, case studies, as well as interviews with the fund managers. Remember, this is representing venture capital funds and not necessarily angel investors and, family offices and that kind of like. So there is some level of granular reporting, cash flows that are actually being reported on these cases.
Does this tell us something about how the industry is changing in South Africa? I mean, is it maturing in some way?
Yes, most definitely. So we definitely are seeing early stages of maturity in the venture capital industry. These sort of exits are not isolated success stories, but it's definitely an indication of a market that is looking at diversified pathways to exits with more exits routes as well as diversification pathways as well. So it could be trade sales, international or domestic M&A, IPOs, or secondary transactions, and they're increasing in value and size.
If you are a venture capital fund and you buy into a company and you get a lot more money out, you make money out of it, you're then able to invest in another company and do the same again. And the whole reason I point out the obvious is that it creates a virtuous cycle. In other words, over time, it should lead to a lot more investment in success stories in our economy. And I realize there's a lot against our economy, so it's hard to sort of measure that. But do you see any evidence that that's beginning to happen?
Most definitely. I think sometimes as South Africans, we don't take the credit that we should actually do. And this is quite a successful story of us, of what we see in the venture capital space. Often we have founders who, exit the business, decide to go back in for another round, launch a second fund, end up going back into the ecosystem as, transaction advisors, angel investors, mentors, taking up board seats. So you do really see proof that these transactions have spill-on effects. It's quite a flywheel sort of impetus in that space. And we've seen quite a few examples of this as well.
No, I'm sure. So then when you do this, I mean, you want to see all of that happening. Is that increasing the number of people who are putting money into venture capital funds? I mean, people will be looking at numbers like this. Obviously, they'll be doing their own research. They'll make their own decisions. But does that increase the amount of money that's flowing around looking for investment? More and more people are thinking, I've got a little bit of money. I can see people are getting twice the return. I'm going to go and do what those people are doing.
Yeah, it definitely creates the evidence for more investors into the space. As SAVCA, as the industry body for private capital in Southern Africa, we, pride ourselves on the research work that we do. And we thank our members and the industry for giving us this data so that we are able to present such compelling statistics. In terms of pension fund regulation, Reg 28, 15% of that capital can actually be allocated to private equity, venture capital, etc. But we see such a small percentage of that allocation. Research like this does give investors tangible numbers, tangible data points to see what investment in venture capital can actually do. And the comparability to other benchmark standards as well in the US. We also have to understand that South Africa venture capital is still very much early stages. We're not as progressed as the Silicon Valley. And we are definitely showing some of the trends that we are growing and that there's more confidence in the numbers that we are able to generate in the space. So we're definitely hoping to educate a lot more pension fund trustees, a lot of international investors, more family offices, that this is a very viable space for you to invest in because you're having very diverse and lucrative exit pathways, as well as a maturity. It's not a one-off sort of transaction. You're also financing a lot of innovation, as well as, real economic growth in the country, creating that sense of entrepreneurship and developing those entrepreneurs in the space. So we also think, from a portfolio returns perspective, you need diversification from a pension fund allocation. Venture capital definitely is able to give you that portfolio diversification.
Were there particular sectors that seem to be doing better than others? I mean, it'd be very easy to sort of skew numbers one way or another. Or were the cases, your 276 cases, was it a pretty broad spectrum?
It was a broad spectrum, but one of the key themes coming out of the research is definitely, fintech featuring very strongly in the study. South Africa has a very long history of financial services innovation, and I can say this quite clearly, having lived in London for a couple of years. Our banking system is far more sophisticated from a retail banking perspective in South Africa than it is in some of the UK banks. So you often have, innovation that is acquired by banks, telcos, and retailers that are actually developed by venture capital businesses in the space. We've featured some very pronounced examples of that in the study, and it really is that ecosystem. we are hoping to see the next round of exits, and we definitely believe that there's quite a lot more potential in the pipeline, given the massive exits we've seen in the last 2 years. And we're also expecting to see other themes coming into the space as well. So more fintech for sure, but also biotech, agri-tech. This is what venture capital's sweet spot is, the ability to accelerate technology innovation in the space.
Yeah, no, I hear you. Anusha Naidu, thank you so much. Really do appreciate it. The CEO of the Southern African Venture Capital and Private Equity Association, 19 minutes after 7.
The Money Show, Africa Business Focus.
With, of course, Professor Rotendo Windwingi. Prof, he's the founding director of the Tribe Africa Advisory, and I'm obviously all over the place tonight. Rotendo, good to have you back. The battery rental company, Mopo, they've signed a big deal that's going to give them battery rental access. They'll expand that across Nigeria.
Good evening, Stephen. And don't worry, if you're all over the place, as long as you're here in Africa, that's what counts. And we've got your back, Stephen.
Thank you.
So, Mopo, it's an exciting story because these are the kind of stories that take Africa forward. They've teamed up with, and this is in Nigeria, Stephen, with a UK-backed company, an investment of $75 million. And one of the big challenges that is there in Nigeria, obviously, they've got a huge challenge with power. The grid collapses probably up over 100 times in the last 10 years. There's a huge dependency on diesel, and obviously that contributes to a negative carbon footprint. So this solution is a battery rental solution whereby basic people or low-earning consumers can actually rent out a battery that will power up light appliances like cell phones and small gadgets. They've been able to probably supply about 32 million of these kind of rentals between the DRC and Nigeria. It makes a huge impact because obviously it allows access to electricity. This UK company has teamed up with the Nigeria Rural Electrification Agency. So it's a positive story in terms of driving electrification, but in a clean, effective and affordable way in Nigeria, Stephen.
And Raxio is securing fresh backing. This is a lot of demand for data centers in Africa, lots of conversations about it. And Raxio Group, they're a big data center operator.
Actually, indeed, Stephen, and they've just invested in over the last few months with another 30 million to make it a total of $380 million US. And Raxio, Stephen, is backed by two big companies involved in this transaction: Meridian, which is from the Europe, and then Roha from the US. And these are big technology players. And basically, the investment is to expand data centers and functionality and infrastructure in Africa. It will add probably about 10 megawatts of electricity. That's the capacity they want to do. What's driving this demand, Stephen, is obviously AI. It's not only does it need infrastructure, but it also needs energy. So a lot of infrastructure around it. Raxio operates tier 3 data centers, Stephen, and the countries that they're primarily active in is Uganda, Ethiopia, Mozambique, DRC, Cote d'Ivoire, Angola, and Tanzania. So quite a nice spread in Africa, but bringing a solution of infrastructure and technology much needed by the continent.
It's also going to require a huge amount of electricity and possibly a lot of water as well. And those are going to be very interesting issues to watch.
Indeed, Stephen, and that's why if you look at all the dynamics in the ecosystem, the solution can't be myopic or siloed. It actually has to realize that, okay, where you get the energy from, and that's why infrastructure around energy and clean energy is absolutely important, and water. And it talks to infrastructure again, Stephen. We've got a lot of water in Africa. We're covered by the Atlantic and Indian Ocean and the Mediterranean. How can we utilize all of those different natural assets in line with this? A key point indeed.
And the Jindal Group, they're based in India. They're investing a lot of money in an electric coal mine.
And this is in Mozambique, Stephen. So Jindal, a big investor. The coal mine is the Vulcan, big coal mine in India. They have invested in $160 million, $160 million US in electrifying some of the operations that affect fuel, that affect rail transport, coal processing, Stephen, just to name a few things. But why this is so important, obviously coal has always been, we know that it's here to stay for a bit longer, but more importantly, how can you reduce the carbon footprint around the ecosystem and the value chain of coal. And electrification is one of the big things because you also reduce the dependency on diesel, which is a big requirement, especially in that space. So a great story to hear from Jindal, an Indian company that has been investing significantly in Africa and Mozambique, and they continue to invest. So it'll be good to see how this turns out. But at the end of the day, great story for Mozambique. And remember that big ExxonMobil, Total, big projects of oil and gas happening in Mozambique also complements this. So a lot of good things happening for Mozambique from that space.
And then the Curtiss Wright Corporation, a big American aerospace company, they're coming to Morocco.
They're coming to Morocco, and the Wright brothers, Stephen, I always worried that the Wright brothers never made money. So now, although they've passed away, they actually have got, their name is one of the biggest aerospace manufacturing companies in the world, which is called the Curtiss Wright Corporation. And what the specific project that is invested in Morocco, Stephen, they've invested in a project that looks at the advanced aircraft treatment of the surface of planes. So aeroplanes, obviously, because of the nature of the exposure, speed, the wear and tear that they go through, you need to make certain treatments and make certain oversight in terms of managing and maintaining that. So it's a very specialized functionality. This business is growing in Morocco. They've invested, as we know, Curtiss Wright is a big $27 billion company, but the Morocco aerospace that is part and parcel of this investment employs about 155 different companies that are involved in one way or the other, 25,000 skilled workers, and exports around $3 billion. So this area of focus in terms of their step towards industrialization, making significant inroads, and it's quite a great investment because it's a global multinational riding on the waves of Morocco, which is becoming more industrialized under the vision of Kim Mohammed. But a great story with regards to global expansion of a multinational in Morocco, which is part of Africa.
In Rotunda, we've got 10 seconds, but people have been skiing in Lesotho.
It's specifically Maluti. It's becoming an attractive place for skiing, Stephen. Temperatures in August and July go to 8 degrees Celsius, heights of 3,200. You don't have to fly all the way to Europe. AfriSki is one of the big players that's participating in this, and that tourism around skiing contributes 7% of GDP. And it employs, it's probably about 1,500 over the last year alone that come to ski in Lesotho. So next time for your skiing holiday, Stephen, don't go to Europe. Just get in the car, cross the border, and you're in Lesotho, and you can have a good skiing holiday for you and your family.
Professor Otendo Ndengwi, thanks very much indeed. Founding Director at Tribe Africa Advisory and author of the book Rumble in the Jungle Reloaded. Well, we know what he likes to do during the holidays. 28 minutes after 7.
The Money Show.
Personal Finance with Warren Ingram.
Well, live and in person, without a jar of crunchy peanut butter, though, is Warren Ingram, our personal finance expert, and of course the certified financial planner and also co-founder at Galileo Capital. Warren, it's wonderful to see you in the flesh. Good evening.
It's wonderful to be in studio. Thank you.
It's not that great. We're talking tonight about buying a property to rent out or buying a flat to rent out. Lots of people are very keen on this. It seems like a good idea. You're told to, get in the property game often. Lots of things that don't tell you. And there's always someone talking about it. And then there are also nightmare stories. Where do you start with? Is this a good investment or a bad investment?
I think it's maybe allowing, like any good investment decision, doesn't start with what you believe. It starts with what do the numbers tell me. So I would say that if you're having this kind of a conversation with yourself or with a partner and you're kind of discussing this, don't start on the basis that I know property is a great investment, or alternatively, I know it's a terrible investment. Start with, I'm doing a value, like I'm doing a number conversation. It's called investing. It must be about numbers. I do this so that I make more money than I had 5 or 10, 15 years ago. And I think a lot of the time this debate starts emotively. It starts with your parents, your grandparents, or somebody saying, don't pay off, the landlord's bond, and you should be the landlord. And, there's so much demand for property. Look how many buildings they're building around Sandton, or whatever the deal is. All of that's nice, but it doesn't get to a number. So I would say, one looks at numbers once and first and second and third and fourth, and then you start to think about all the other stuff afterwards. And I bet you most people that have got a good story did the numbers properly. Most people who've got the horror story, I'm not saying it's their own fault, but they probably didn't do the numbers like they should have.
Okay. So if, for example, you buy a flat for 1.2 million rand, you're paying a bond of over 20 years, your interest rate's, 11%. Your bond payment is sort of around 12.5. You would have to find a good tenant and to go from there. And that's the starting point for this conversation.
Yeah. And I think a lot of the time people don't do that sum correctly. So you kind of go, well, I know lots of people looking for a property. I'm just going to buy it and the tenant will pay my bond. No, that's not how it works. It's incredibly rare that the property market gives you the opportunity to take 100% bond. So you're borrowing the whole amount that you owe, and that you can find a tenant that will pay off that whole bond every single month from the first month. Why do I say that? Because otherwise the tenant wouldn't be a tenant. They would just buy the property themselves.
Yeah.
So the truth is that you are going to buy a property in most instances where the bond is going to be bigger than the rent that you can earn. So in the very first month, and it might well be for 3, 4, 5 years, your rent is not going to be at the rent that you're earning is not going to be at the level of your bond repayment. We haven't even got to the costs of, okay, what about all the other stuff that I've got to pay to be an owner? It's not just your bond. There's a whole lot of things that you have to pay in addition. And I think it's that very first conversation that you've got to get right on day one. Okay, fine. This bond is only 1.2. It's a nice apartment. It's close to the city, whatever. It's easy to travel. It's not that expensive. It's 1.2. Fine. That's not the conversation. What's the rent that I can earn from a property like that is close, and all of those things?
You mentioned other costs. I mean, this is often the thing, right? Is that you'll look at the bond and you'll think, well, that's the big number. That's my target. Okay. That's what I've got to do. But suddenly, and I mean, this is the thing about property, all sorts of other things start to come literally out of the woodwork.
Yeah, like the analogy. So you've got, firstly, we've got your fellow shareholder in the property, which is the tax man. So you're going to have to pay your municipality. You're going to have to pay rates. You're going to have to pay, if it's an apartment, that means it's a body corporate. So that means you're going to have to pay levies on top of the rates. Then you're going to have to pay for the insurance of the stuff inside the apartment. Not saying if you're renting it out, you're not insuring the kettle and the fridge, but you're insuring the carpets and the walls and all those kinds of things as well. So you've got insurance as well. I would suggest as well that you're setting aside money every single month from the very first day for when the place needs to be repainted or the carpets need to be redone. And you hope that that's not with a nightmare tenant that does it after the first lease. You hope that's in 5 or 10 years' time. So all of those costs are in addition to the bond that you've got to pay.
We're talking to Warren Ingram in Personal Finance tonight. Your questions for him about rental property. Does it make sense to buy a rental property and then to try and let it out? What do you need to know? What are the hidden costs? Are there any benefits? Does it work? How do the success stories actually work? Your questions for Warren. 011 883 0702 021 446 0567. And your voice note questions as well on 072 702 1702. There are other things too. I mean, you have to often pay someone to manage the property, or you have to put in the hours yourself.
Yeah. So, I mean, I love this. People say, no, I'm just going to get an agent and they'll take care of me.
Yeah.
They'll look after everything. Really. What they want is they want to get someone into that property as fast as possible, and then they want to earn their 5 or 10% a month thereafter. And if it goes wrong, what they've lost is their little bit of the rent.
Yeah.
That's all they've lost.
They don't care.
Maybe it's an opportunity for them to get someone else in again, and so they go. So unfortunately, you've got to look at this and say, if you're going to pay an agent, it's not fire and forget. You just need to know that. So you're going to pay the agent, you're going to pay the rates, you're going to pay the levies, you're going to pay the insurance, all of those things. I think you're probably in for a good few thousand, probably closer to 4,000 on top of the bond repayment.
Sure.
And I did a quick search for, in preparation for the show and looking just around this area, what would be a 1-bedroom apartment? Let's go at that 1.2 million. And I think you're going to be, pretty happy to get rent of about 8,500 a month. So you're paying out 12,500 or 12,000, whatever the number is for your interest. Let's say you get a decent interest rate. So now you're paying 12,000 on the mortgage. You're paying another, let's say 4 on all the other costs that you have to pay, and you're getting an 8.5. You're going backwards pretty quickly. So in your first year, you might well be back, underwater by about, let's say, between 80 to 90,000 rand in year one, and that's if everything's gone well. That's if the tenant's paid on time, everything's worked out. So it is a real thing to be able to say, have you done that number before you buy?
Sure. I mean, it's amazing how many costs they are, but you sort of forget that this is a property, and properties come with costs, and it takes you straight into the should you rent or should you buy debate as well.
Yeah, so maybe, I mean, I don't want to paint the picture that buy to let is always a bad idea. I don't think that's true. I think making a buying decision to any investment is, what price can I pay? Can I get a really good low price? So, for example, if new apartments are being built at 1.2 million, and you're in a close to Sandton, can you find an old apartment? Maybe you spend 100,000, and you're paying maybe 900,000, and suddenly the 8,500 rent that you're getting versus a 900,000 rand property, is that a better deal? Can you start to make the numbers work? Or is there some special situation where you find, someone that's happy to pay a much higher rent for stability or certainty or something? So there will be times when your starting price or the starting rent make it a very attractive proposition. And I think that's the thing that people don't, the sum that they don't do. So yes, understand your running costs are probably, as I say, 3,000 or 4,000 per month, more than what your bond's going to be as well. It's your bonds on top of that. But now, how can I make these numbers work? And if you can't make the numbers work, then ignore what everyone's telling you, all the armchair experts, and just go, this is a lousy investment for me for now. I'm going to park it and do something else.
Okay, there are also big risks. And the first big risk, and this happens so often, is that your flat is got no one in it for a while. So you've got the bond and you've got no money coming in.
Yeah, and either that you just don't get a tenant, or the real nightmare, you get a tenant that comes in for 3 months and then stops paying.
Yeah.
Now, in South Africa, I think it takes an average of 6 months to follow the process to get a tenant out who has stopped paying. You've got to follow. There's a very strict process that's written down in our law, and you've got to follow that process. You can't just lock them out and say, well, get some bouncer to come and bounce the tenant out. You've got to follow process.
And there's lights and water in the meantime.
Lights and water. You've got to pay the bond. You got to pay your rates, all of those things, and now you've got to pay some lawyer to go through the process of all the things you've got to do. So that's the nightmare scenario. But back to the tenants, the tenant deal. If you're in a one-bedroom apartment, it doesn't mean that person's going to stay there for the next 10 years. They're probably going to move every 2 or 3 years themselves, and you'll be getting a turnover. So you might well be losing 1 month of rent every year, and just to work it out, that's 8%. So 8% of your income every year, if you've got turnover of property, is just being lost to an empty place. It's almost impossible to say, okay, you're out on the 31st and then you're in on the 1st.
Yeah.
The likelihood is it's empty for a month if you're lucky. And if you're very unlucky, 3, 4, 5, 6 months.
Sure. There's also concentration risk, which is about the amount of your capital, the amount of your money you're putting in one place.
Yeah. So this is the eggs in the baskets conversation. So the way I would say this is, we take 1.2 million rand. We borrow, actually, we don't even take our own money. We borrow 1.2 million rand from a bank. Remember, these are not your friends. It's a bank. And I say to you, why don't we go and buy one share that only has one customer and only works in one market in one city? This is a great investment.
Yeah.
The best thing that you could possibly do. But when you do that for property, somehow people are okay with that. So the concentration risk is simply, now you're taking all the eggs you have, and you're borrowing money, and then you're putting them in this basket, and then you hope that this basket's going to be okay. We've all lived in Joburg in a time when the property prices go down, and so that story doesn't always work out. It does work out if you're extremely lucky and you've got a place on the south coast of Natal or in the Western Cape or Hoedspruit or something, but it doesn't always work out.
Okay. We need to consider SARS. I mean, we always need to consider SARS. Death and taxes are certainties. Where does SARS come into the picture? Because this is income, and also there might be capital gains tax too.
Yeah, people, especially first-time landlords, this is the thing that catches a lot of people. So they start this and they think it's fine. It's my property. This isn't a salary. It's not. There's no PAYE. I'm fine. I don't have to pay tax on this. Unfortunately, rent is definitely taxable. It's exactly the same as if you were earning interest. It's part of the taxable income. It's going to attract income tax. So yes, you do have to pay, and you have to pay it from the very first year that you're in this deal. So don't forget that. What is nice is legitimate expenses. You can't now go and write off a whole lot of things like your new wardrobe because you had to make yourself look nice for potential tenants. Real expenses, real maintenance, those things you can write off against the tax. The tax you have to pay, and also then the interest that you're paying on the home loan. That's an expense you can write off. So there is a benefit to using SARS to help you in this deal. But remember now, It's not your property. It's a property that you're renting out. And when you sell that property one day, you're going to have to pay capital gains tax on the whole value of the entire profit. Why am I emphasizing that? When you sell your own private home, the thing you live in, you get quite a nice big gain before you have to start paying tax. It's about 3 million rands worth of profit before you actually start to pay capital gains tax. On your rental property, capital gains tax from the first cent.
Okay. Just to sort of also manage the fact that you are paying money, so you're paying a bond. If your bond and the rent come to the same, if you're just covering your costs effectively with the rent, won't all of that be deducted from the tax anyway? Would there be no tax?
No, because when you pay your mortgage, your home loan, unfortunately, it's not all, well, maybe fortunately, unfortunately, but that whole value is not just interest. So a portion of it is actually capital that you're repaying. Right. And so there's no benefits to that. It's only the interest portion of the repayment.
Okay. It's 12 minutes now to 8 o'clock. We have a question from Gail. Gail, hi. She says, I'm 47 years old. I have a retirement annuity I bought 12 years ago. I've been paying money into the RA every month. It's not doing well. It seems the growth has been poor. The fees are high. When I raised this with the advisor who sold me the policy, he said I must not cash it out and I would be penalized if I stopped contributing more money. He said it will come right if I just keep paying the last 8 years until I am 55. Should I keep going or should I cancel this policy? Yeah, that's a very interesting question, actually. Warren Ingram will have an answer for you, Gail, in just a moment. It's 11 minutes now to 7.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking, turning intent into execution. That's how Absa are invested in Africa's energy future.
The Money Show.
Personal Finance with Warren Ingram.
Got some voice notes for you, Warren, but first, Gail's question. I'm 47. I've got a retirement annuity. I bought it 12 years ago. I've been paying. It's not doing well. The growth is poor. The fees are high. The advisor says you have to pay. You'll be penalized if I stop contributing, and I must just pay for the last 8 years. What should Gail do, Warren? I mean, this happens often.
I can't say rude words on the show. So I'm trying to...
Yes, you can.
So let's say this, Gail, number one, I'm really sorry. Number two, what you can do is you can ask for a quote, which is called a paid up value quote. So what it'll do is, let's say your RA is worth R1 million. That's what they tell you the fund value is. If you ask them for a paid up value, what that will mean is, if I stop adding any money to this, what's the value then? And it might be a bit lower, but it gives you an idea of what the penalty will be. So that would be the first thing to do. The second thing is a Section 14 quote, which is you transfer this RA from this company to an investment platform where the fees should be much better, because I suspect this is about fees. And find out what that value is. So you might find that your RA is worth R1 million, but they're going to penalize you 100,000, which sounds like a huge amount of money, and I know it is, but it's 10%. And I feel that if you've got 8 years to age 55, and then you might carry on working to 65, what you want to do is go to a place where your fees are not 3.5% or 4% a year. They might be 1 or 2% a year. So that 10% that you might be paying as a penalty now, which I know is galling, actually you could make it up over a couple of years and then get many more years of good capital growth. So I would ask for those quotes to find out what the penalty will be, and then make the decision. I feel don't be fooled by that you've only got 8 years. You've got 8 years plus. So don't get stuck by that argument.
Very quickly, shouldn't an RA always do relatively well? Why do some of them do so badly?
I mean, to give credit, sometimes it's just the market conditions are not favorable, but a lot of the time when it's these kinds of structures where there's big upfront fees, then there's big annual fees, and it's hard to figure out what you're actually paying, it's because you're paying an enormous amount of fees. Yeah. So even though the actual investment's doing well, it's being dragged down and kind of ground to a halt by very high fees. That's making this advisor obviously very rich.
Sure. Okay, one or two voice note questions. Let's take the first one on 072 702 1702.
Hi, Warren and Steve. Great show. This is Kathy from Sandton, and I have a question. We have a house, and we're considering selling it. We haven't built a lot of equity on it, but we think we can get not a substantial amount, but enough to put on a deposit for our next home. But our debate is, should we lease it out or wait until it gets a little bit more equity? Because in our area, we can lease for like. So the example you gave, 12,000 for 12,000, we can get that, but we would have to then pay the shortfall of the levies. So we're not sure if it's worth the hassle Or should we just sell the house, get a little bit of equity, and move to the next house with a little bit of that as a deposit? Because right now we're debating, if we don't get the exact price we're looking for, it might not be worth selling.
Yeah, Warren, I mean, this is how people end up with two properties, isn't it? Because they move on to the next one.
It's such like an intuitive thing. Well, I know the property well, I'm sure I can rent it out and everything will be fine. But back to the point we raised a bit earlier, what happens if your tenant is a nightmare tenant? And now you've bought a new place and so now you've got to fund new bond and you've now got a problem tenant in the one that you were banking on where to pay off some of that bond. So my view is if you treat this as a proper business and it's not a fire and forget scenario, maybe it makes sense. But in most instances, if you don't want to become a professional property investor where you're managing buildings and you're managing tenants and you can make some profit out of the thing, sell the thing, and then put all of that into the house that you're going to live in, and then you keep that bond as low as possible. And, the whole trick here is still to try and be debt-free and build capital so that it compounds for you, not to then say, well, I've still got now two sets of debt or one and 10%. I think you want to be debt-free. That's really the power here.
Okay, so that does make sense, actually. And we've got another voice note for you as well this evening.
Hi, Stephen. This is Fred from Clayville. I just want to find out from Warren, right? I've got a property which is about 1.1 million, right? I'm almost done. There is about 6,000 rands left for me to pay it off, right? So now I want to find out from Warren Ingram, is it advisable, boss, in 2 months' time I'll be turning 16. Is it advisable for me to pay off that house and then get another property? I understand you guys are talking about buying property to lend, to rent out or to lease, whatever the word is. So what's Warren Ingram's advice on that? Thank you, Stephen.
Thank you. Yeah, Warren?
Warren Ingram doesn't love property.
He doesn't.
So, and it's not because I'm biased. I just think you're 60 years old. You want to be building up your capital as fast as you can to when you're going to stop working, to when you hit retirement age. So you've got to be very sure of the tenants that you've got if you want to make it a property business. Otherwise, invest the money and spread your risks far and wide. Remember, it's a 1.1 million rand. Back to my one share example. That's 1.1 million in one property, in one city, in one country. I don't know. I'm not the biggest fan of doing that.
No, sure. Okay, Warren, we do need to wrap it up and we've got a couple of minutes left. But is there a way to know when the numbers do make sense to buy, when you should go ahead?
Yeah, so I'm sorry, we never like doing jargon on this show, but there's something called the yield, the rental yield. So what you do is you take all the rent that you could earn in a year. So you take your monthly amount and you times it by 12. Then you work out what's that as a percentage of the value of the property. So it's a bit like if I put R1 million in the bank and I get 10% interest, the yield is 10%. So if I've got R1 million property, what's the rent that I'm going to earn? And that's the yield. So over a year. Now remember, the deal here is not the rent before costs. It's the rent after costs. And if that rent after costs is at least better than inflation and it's escalating, it's growing every year, you might be doing okay. But if it's 8 or 9% after costs, it's a very good buy. So for me, I'm looking at about 8% as my after costs yield. Then I would be saying to myself, this is a good property. The price is right and I'm getting good rent. But if it's 1% or it's negative, which, at the start of a property's life, that's what's going to happen, then I'm thinking very carefully before I make that decision.
So there are times when it does actually make sense.
There are, and it's almost situational. I mean, I remember in the late 1990s in Joburg, the rents were amazing relative to the price. So that was a great time to be a property buyer. Then you almost wanted to buy as much as you possibly could. But there are other times when rent is very low relative to the value of the property. And then it's a terrible time to be a property owner.
So if you own property in the Cape Town City Bowl right now, it would be a good time for you. If you had an option to do it, it would be a good time.
Well, I think you've got to do that calculation because I'm worried that the property prices in the Cape are very high. So yes, rent is high, but how high is the rent relative to the price that you have to pay for the property? It might be that Cape Town properties have peaked. And actually maybe, I don't know, I'm not the property guy, but I'm wondering for myself, is Joburg not the property buying opportunity because our rent's not going better relative to the capital that you're going to have to pay?
Warren Ingram, thank you so much. Good to see you. Really do appreciate it. Warren Ingram is the co-founder at Galileo Capital and, of course, a certified financial planner on The Money Show.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking, turning intent into execution. That's how Absa are invested in Africa's energy future.
Well, things turning a little positive in the US finally. The Dow Jones is up 1.12%. The Nasdaq was flat, up 0.01%. And the S&P 500 up 0.35 at the moment. A lot more to come this week. Of course, there's a Fed decision tomorrow. We're expecting a big decision there. Also, a lot more earnings started to come. And then that warning from Fitch, the ratings agency, they're a bit concerned, as am I, as was our market commentator tonight, about the possibility of an AI correction, which did sound really a little bit more exciting than we might like it to be. A lot more to come, of course, tonight. Sia will be with you through the evening in for Aubrey, and we'll be back with you tomorrow. Good evening. It's 8 o'clock.